We're snorting cap rates and shooting up cash flow here at Deal Junkies. Welcome back to Deal Junkies. We are back in the studio, excited to have the 4 OGs in our new studio. It feels good, doesn't it?
It does, yeah. It feels upgraded. We've elevated.
Yeah.
You know, Mark told us he wanted to co-host with us at times, so he was like, hey, you can come in tomorrow. And then he told us he was too busy with work after we just did a podcast on how he's always too busy with work.
He doesn't realize this is work.
He's a slow learner.
If we tell him this is work, then he'll show up.
You need a Nancy Kerrigan him. You just need to have someone beat him up and take him out for 3 months, and then he can't work, and that you force him to not work for a few weeks.
You're saying we should break his leg?
He loses maybe something different, like give him COVID or something. Just make sure he can't work for a few weeks so he can see the beauty.
No, he'll never stop.
You can't stop that man.
If he was in a coma, laying in the hospital, he'd have his laptop on him somehow, sending emails. I asked the question in that episode. I said, "Are you guys workaholics?" And Mark was kind of like,
"No, I just like doing it all the time more than anything else." That's all I can ever think about.
We have childhood trauma from our Mexican dads forcing us to always be
don't watch TV. All right, guys, what are we gonna talk about?
So we're gonna talk about econ, even though me and Mike made a bet.
Wait, I want to hear about the bet. I saw something on social media. It was like what was that?
So okay, here's what happened:
a survey to see who wants to hear about econ.
Yeah, I said if we take this survey, the number we came up with was 70%. 70%, which was a crazy number to pick.
No, let's give context. We were talking about econ, and Trevor was doing what he does, which is just turning his brain off and making it a difficult conversation.
Oh.
And I said, at least half
I was
of our
asking
audience,
the hard-hitting questions.
At least 50% of our audience wants to hear this. And I said, then I do what I do and went 70%.
Because you felt that confident.
Yeah, and then he said, bet. And then he forced a bet that
we both agreed upon a mutual agreement.
Yeah, but I didn't get any control. He posted
it was contractually illegal
Instagram story, so a 24-hour poll with very terrible verbiage. Like people didn't even know what they're voting on.
Like who wants to hear about econ?
Talk to Avery.
68% voted for
65.
economics. 68%.
65.
And then I got 4 more direct DMs telling me how crazy Trevor was, that he doesn't want to do this. So I'm actually really proud right now because Trevor knows his audience. He knows they want to listen to it, and so he's going to allow this.
To Mike's credit, way more people said yes, they liked it than I thought they would.
And Trevor also had like 8 people say no that didn't know anything about it.
To be fair, though, only like
had people chime in,
and Trevor has 4 Instagram accounts. So
only like
no,
he shared it with 1,000 people and said, "Mark, no."
To only like 20 people voted on it, or like 18 though. So that's not that big of a
a big sample size.
But it's not statistically significant,
and it was worded poorly in my direction of no, I hate econ. And that hate is a strong word.
If you actually apply that
you use all the time.
Let's not talk about this. Let's talk about your econ because it was high enough, and I'll let you.
Oh, Trevor's going to let you talk about econ.
There is a valid statistical group of our 26,000 listeners, and if you break them into the 80-20, and then you break those 20s into 80-20s, there's at least a 16,000 person audience that really gets value from this information.
We have like 31,000.
I have no idea what you just said.
But that's what statistics are.
But I believe
throw out numbers.
Yeah,
he doesn't know what he said either.
Let's talk about this really fast so that we can talk about the other stuff.
Yeah,
the Gandalf 418.
We have Gabe here, so we have a leader in the clubhouse that can ask good questions, guide us down a good road. That the audience, the people,
Mike, what's happening in the econ world today?
So
are we under 418?
PCE came out. It came out as expected. 2.9.
Mm-hmm. What was this? PCE?
PCE. This is the one that the Fed uses as an inflation indicator. This is personal consumption.
Okay.
So this is the one that they don't look at. They don't swap out like, chicken went up in price. They look at what are people actually paying for meat. When chicken goes up in price, they buy beef or whatever, right?
Okay.
So this is the one where, correct me if I'm wrong, but they do core where they take out food and energy, Core was like 2.7, but then our normal PCE, and I don't know which one they follow more closely, but we were at 2.9, which is what the market expected. It's what the Fed expected. Everybody was thinking it was going to come in around this. So we got what they were expecting. There were no surprises. But Mike's been talking about this Gandalf thing for a while, and it was 4.18. The 10-year yield made it all the way down to 4, and now we've gone back up, but it hasn't gone above 4.18. I think it hit 4.18 earlier today.
4.19 earlier today.
Oh, was it? It went over.
Yeah, and so we talked about ceilings of the 10-year. If we back up, we had the 5, then the 4.5, and then for this year we've been talking about jobs revisions. We had the big revisions in August, and then more revision numbers in September. And so that 10-year yield came under 4.25 before the Fed cut. For about a week or 10 days prior to the cut, it hovered between 4.0 to 4.03, excuse me, 4.03 to 4.07. And that's where the discussion of mortgage rates will go up when the Fed cuts, because they had been declining all throughout August. So yields have been going down, mortgage rates have been going down. The Fed cuts, that 4.03 to 4.07 kind of little hovering went into the 4.1 range. And then we had a jobless claims report come out the week after the Fed cut, which was weaker than expected, meaning less job firing. So less firings, a strong jobs report. And then that bumped into the 413, 415 range.
So is the economy good or bad right now?
That's
I was reading an article yesterday, and it was talking about how very few times in history does the stock market go up at the same time gold goes up. Mm-hmm. And it's a bet. I don't know if this is true or not, but in the article it said it's a bet against the U.S. dollar.
Mm-hmm. We're about as close to stagflation as we've seen in our lifetime.
So that means prices are going up, but growth is not.
Correct. We did have a revised GDP report came out yesterday, and that came out higher. So Q2 GDP was 3.8% instead of 3.6, if I remember correctly. And so that pushed pressure. Yields went up because of that, right? Because we're producing, our GDP is growing in that aspect. However, you can't ignore the employment market, the jobs reports. It's been consistent on the revisions. It's been consistently going down.
So the jobs market is stable but weak?
So, yeah, it's interesting because a couple weeks ago, we had, for the first time in a long time, we had more people looking for jobs than we actually had jobs.
Yeah. Just to stop for a second, I think it was in 2022 we peaked out where there were 2 people looking for every 1 job that was available. And just last month, they said there's only 1 person or less than 1 person, just slightly less than 1 person for every 1 job that was available. So we went from a 2-to-1 ratio to a 1-to-1.
Yeah, but it was that the 1-to-1 is, so you're comparing like a COVID issue, but I don't even want to get into the details of the reports, but just kind of
the point is that there's a job available for every person looking for a job right now. I mean, if it matches up that way,
correct. But what we're seeing
for everyone.
What we're seeing on the job side is layoffs are not happening as fast as we expect layoffs to happen, but people are you're getting fewer people employed every month. So we're weak on the demand getting hired, but we're not putting a whole lot of new demand into the marketplace.
Okay. Which is kind of like it feels like we're just on cruise control.
Yeah, exactly. Which is why the stock market's at a record high and it's not coming down, is because if you're an investor and you're looking at PE ratios and you're looking at where do I allocate my money, you already have a lot of money allocated to money markets. You already have a lot of money allocated to Bitcoin. You already have a lot of money allocated to gold, but you're not hugely concerned about the economy as a whole. And AI is taking off, so a lot of money is going into AI.
Sure.
So like this morning, the stock market is up 200, Dow's up 200 points.
On the PCE reading, is that what caused it to go up?
Yeah, initially you didn't have any bump in the yield on the 10-year yield. And then when I started looking now, it's gone up a little bit. And that's probably money going out of the bond market into the stock market. And so you have that, Trump has done a great job solidifying the future of AI, and there is a lot of investment in AI. So there's a lot of investment in the stock market. And the other thing you're seeing is these AI deals being done between like OpenAI and Oracle, $100 billion investment. So Oracle's going to invest $100 billion in OpenAI so they can build infrastructure for data centers. And then OpenAI is going to buy $100 billion in chips from Oracle or whatever that agreement is. So you have a significant amount of investment, but just think about that. That's just balance sheet leveraging. That's not, it's like left-hand money, right-hand money that increases the entire balance sheet. So it's really interesting to how do you value these things right now. But the when it comes to real estate, what has happened is we got below the 425, we got below the Gandalf line, which Logan Yodamashi talks about. I don't know why the details he talks about 418. We got down to 4, but in my mind, what was good about 25 versus 24 is we didn't go under 4% yield in the 10-year. We didn't get way down ahead of the Fed cut. Last year we got under 3.75.
Yeah.
And so then when they had the Fed cut, it has to bounce up, and not just bounce up, but it has to bounce up high. And so it went up more than 25 basis points to over 4 and closer to then 4.25. And then we get close to the election and the Trump trade, and then the yields started going up more and more. And so what's good, the way I look at the market is there is much more optimism if you want rates to come down to improve the real estate market, because jobs are clearly weaker now than they were last year. Inflation is still a concern, and that's where there's some trepidation. But that is also baked in to the bond yields. That's what they look at. And so for Trevor, this is really good. You want to know this. So why is the bond market so important? Is because that is the cleanest market that macro money can invest in to get an inflation adjusted return, a risk-free inflation adjustment return. So it's the cleanest investment out there. And so that sets where long-term capital gets placed, and then other rates stack on top of that. And so the fact that that 10-year yield didn't go down below 4, and even though we've had the cut, we've had not one, but 2 jobless claim reports that have come out that have been less than expected, meaning stronger than expected. And we've had inflation reports that haven't been too high, but they've been higher. They're showing a trend of upwardness rather than downwardness. That's baked in because it didn't go above 425. We're still sitting in that 4.2 window. And so it feels like our channels, our ceiling was 5, then our ceiling was 4.5. It feels like we're in a different channel somewhere between, 4 and 4.25. And then that just sets a good basis for rates going forward.
You want to say something?
Do you trade bonds?
No, because I don't want to know the details of things. So if you're a trader, you really need to understand those details. If I did trade bonds, I'd make them like one or twice a year based on bets, like December of 23.
Wouldn't you just buy it when the 10-year's highest? That's the move on bonds.
Yeah, but I'm just not a trader. I'd rather just invest in real estate.
Yeah.
I want to know macro. The details, I think, throw a lot of people off. I want to know the macro. And like when headlines come out, I don't read the headline. I go to the bond market and I contrast what I see happens in the activity in the bond market compared to the headline. And that's my filter for the news that's coming at me.
We should all go trade 10 grand on bonds and do it as
See how we do?
Yeah.
That'd be a fun little experiment, except we all have too many things to do.
As real estate investors, the only thing I care about personally, there's kind of 3 things. One, I want our lenders to lend us money. So I want them to feel good about where we're going. And I felt like if we got a 50 bips cut, that would show that there was concern and shock, and we might actually see rates go up. But it went down 25 bips, which was more of we're just taking a cautionary approach to it.
Don't lenders want to lend more right now because they're locking in prepays with higher rates, but they seem like they don't want to lend.
Okay,
still.
Lenders don't think like we do.
They make so much more money.
They're on the other side of the coin from where we're at. So they're not looking, they're definitely looking more at downside risk. We tend to be, as investors, we tend to be like the optimist who wants to see all the value add potential and all the upside. Lenders tend to always look, I think, to the downside risk. They're more concerned about safety than they are profit. Yeah. They want to make the profit.
They make so much, though, if they give max loans in the high interest rate environments with the prepays.
But the way they
that's
look,
where the other lenders come into play.
They look at the world differently than we do, though. And they're always looking for what can go wrong. And so I think, number one, we want lenders to feel good about lending, which means, number two, the risk spreads come down. So, number one, they want to actually let the money flow. They want to lend.
Because right now, 225 to 375 on the risk spread on a lot of the stuff we're seeing, right? Isn't that? That's high.
So the 10-year
in the commercial world, it's different in the residential world right now.
Yeah, I don't know where.
To break it down to the way I understand it anyway, is rates are not completely tied to the 10-year, but it is greatly affected by it. And it also affects cap rates, not 1-to-1, but there's about a 43%. So like for every 1 point of interest rate that comes down, our buildings will go up 0.43
cap rate
in value. Yeah. Which if you're talking 5-6 cap, that's like 5-7%.
Mm-hmm.
And so you take $100-200 million portfolio, it's a huge money.
Yeah.
It's a big difference.
Do you know, so a lot of the lenders use not the 10-year for their spread, but the FHLB. What's the difference?
Well, they also, we're doing quality debt, but we have 5 and 7 year calls usually. Sometimes we do 10-year calls, but it really, like Logan, when we're talking about the kind of loans we're going after, he's watching the 5-year more closely. We watch the 10-year really close, but he's watching the 5-year.
Is the 5-year FHLB is what he's like, and what's the difference between those two?
I don't remember what FHLB is.
Okay, because that's
the
like
federal home lending.
Something like that, because that's what every lender is tying.
FHLB is just specific to the U.S., is my understanding. So it's like the overnight rate between the banks in the U.S.
Because depending on the loan type we're doing, they'll be like it's the 30-day FHLB, the 90-day FHLB, the 1 year, the 3-year, 5-year, whatever, 10-year. Depending on the loan type you're doing, and then they'll tie the spread to that based on you as a borrower between 225 to 375 bips, and that
in a spread from FHLB,
and you can look up the daily FHLB rates. You can just Google it. But like for reference, that's anywhere from 3.9 to 4.5 ish right now. So your rate, is as low as 6 up to 7.5, depending on the product type you're doing.
Yeah, you think of it as 3 different buckets. So you have the buckets of pool for the actual treasury notes, the bond market, but then you have 2 different mortgage bond markets. You have the residential mortgage bond market, and the commercial bond market. The residential mortgage bond market, and those are traded daily, right? So their yields, their spreads change daily based on that auctions. On the mortgage side, you're getting a 30-year rate, essentially, but you're getting an earlier payoff. So they can have
prepays and they're refined sooner.
Yep. So they can have shorter spreads than in the commercial world. They have a shorter period of time, and they're tied to a different index. And so that spread's higher. And so it's 2 different bond markets trading. And then allocation. Do you want to be in a 5-year to 7-year bucket, or do you want to be in a 30-year bucket with early payoff risk?
Yeah.
And so that changes where money goes to.
Because it's a similar payoff though when it comes down to it, right? Because they're typically refined payoff around 5 anyway on either.
Yeah, and right. So just again, we have this amount of capital we're going to put here, which is risk free, inflation based. Here we have a little bit more risk because it's in a residential world, and then we have longer inflation versus commercial. We have a little bit more risk because it's commercial, but a shorter time frame. And so that just changes the yield they want on those different investments.
Yeah, because on all our commercial stuff, it's typically a 5-year prepay. We used to be getting 3-year prepays on a step down. Now it's 5, 4, 3, 2, 1 step down on a lot of it, which I don't like. And
how does maintenance yield work? How do you factor in maintenance?
Oh, we haven't been
based
doing
on the rates going up and down.
Yeah, we haven't done any of those.
So if you want to get out when the rates drop, you're paying the difference basically between the investors have to make the return they were going to make. If rates go up, it's not a big deal. They'll let you out of the loan. But if rates go down,
rates like the bond yields have gone up. So if bond yields have now gone above what your interest rate is on the loan.
Yeah, it's like if you borrowed money at 5% and now rates drop to 4, and you're just like, I want to go refinance it, and you have yield maintenance, they're going to want that spread. They're going to charge you, on a $3 or $4 million loan, you might pay $800,000 in a yield maintenance fee, defeasance, right? Because
what?
So those loans get.
I've seen it.
That's not.
I've seen it.
That's doesn't make sense.
When I saw it though, it had dropped down to 3 or 3.5%. But I've seen yield maintenance fees. I've seen people that say, I want to sell my property, and they can't sell the property because there's an $800,000. It's basically a prepayment penalty, but it's not a percentage of the loan. It's an actual spread in the yield
and
that their investors are supposed to get.
Yeah, because their analysis, they need to get the yield they expected when they made that investment.
I do not like a loan with yield maintenance.
What is the benefit? Like, why would someone do a yield maintenance loan?
Rate going in. Rate and term, it's a sexy loan.
Do they get a longer maturity date? So the one I'm looking at, there's a yield maintenance, but rates have gone up, so it doesn't feel like that actually hurts anything. But they got a 25-year amortized loan on a commercial product.
Yeah.
Typically, we're doing 30-year AMs.
30-year, maybe it was a 30.
Yeah, so lenders will try to press you right now.
He's saying a 25-year term.
Yeah, it's a term. It terms out. It doesn't have a balloon date.
Oh, that's cool. I mean... Yeah.
So I wonder if
some of the bigger projects with agency,
Well,
like, they're all like that.
that's what the 800,000 had to be, but that's insane.
It's
because if you've got 10 years of maintenance,
their investors are expecting a certain return on that loan, and you want to get out early, you're going to basically pay the difference, like getting out of a lease early.
But they can redeploy the capital. So isn't the yield
that's
maintenance
how they
supposed
adjust.
to be for
But
the
if they're
amount of time
redeploying at
that
half the rate that they were at in the first loan that they were in, then their investors are making half the return, right?
that makes sense.
So it's not a like
That's stupid.
So those loans getting paid off that still have yield maintenance that were made between 2020 and 2022, there is no risk to yield maintenance because rates have gone up. But those loans being made now, there is going to be risk to yield maintenance
if rates go down.
Yeah.
Yep.
On the buyer side, the owner
Trevor,
side.
make sure we don't do any of those. That's stupid. That's
A prepayment fee, just like a step down, is a much better
whatever,
loan.
dude.
Well, yeah, because it's calculable
On agency
calculatable.
and HUD, it's a 10-year.
One of those.
A 10-year step down,
But they give you a full fixed rate.
You know,
like
at the
30 to
end of the
40-year
day,
term.
though, I mean, those are still good loans. If they're a 5, 4, 4, 3, you know, they drop
It's
down
10,
to 3,
10,
2,
9,
1.
8, 7, 6.
I've got loans that have almost 10% prepays built into them, and I want to refinance them right now, but I've got a $300,000 prepayment penalty.
Mm-hmm.
Then you start to weigh that out. Well, it takes me a couple years to make that money back, and you just do the math on it. But I mean, you're just protecting the lender because they don't want to be paid off and have to redeploy that capital at a lower rate. So
That's why I like seller lenders. They're just so much easier to work with.
for everybody listening that's in the residential world thinking about getting into commercial, I think this is probably the biggest thing you need to understand is that your financing is a totally different market, a totally different world.
Every bank is different.
This is why a lot of people stick with 1 to 4s because you can get, it's
Same debt.
fully
30-year
termed,
debt.
30-year, You don't have to worry about it resetting. You don't have prepayment penalties.
Right now, every lender has been trying to give us 25-year AMs on multifamily, which I hadn't seen before. Like usually they're just straight to a 30-year. Now we're having to
Negotiate
please
it.
give us a 30-year.
It's just another dial they can dial back on the loan just not being as aggressive.
Because I need Sean to learn a little bit more that you can negotiate with the banks. And they can get approval. And the biggest things they'll let you do is first 2 years of IO and then a 30-year AM.
I think
and then
Sean's doing a great job.
He is, but there's always improvements. And then doing the step down rather than a 5 to a 3. And because a 3-year is so much better, especially on a value add project.
And we've had loans where it made sense. We had a prepayment penalty. We just pay it. I mean, you get in a certain position, you need to raise cash, or you want to sell something to go in another deal. You just pay the prepay and move on.
And if you got a low return on equity, so you can pay that and go get a better return on equity and a better deal.
Yeah, it makes sense still.
Mm-hmm.
But I would rather just not have it.
So
I like to eat my cake and ice cream at the same time.
I like to have my
I did that yesterday. Yeah.
So Trevor, when we're doing deals right now, are you feeling like the lenders are starting to loosen up at all, or are they still very, very tight and hard to work with?
No, they've been
hard to work with,
dude.
So why do you think that is? Is it just because there's uncertainty?
No, part of it is we're doing bigger deals now, so we need more reserves and whatnot. And we still get the loans, but it's a little bit harder versus if we were just sitting on 3 to 5 in cash, which is where we need to get to do the deal size we're doing. Is just okay, we need to go sell something or save some of this money rather than reinvesting it to sit on more reserves to make them more comfortable.
We like to fly very close to the sun because we're investors. We don't want to sit on a lot of cash that's not working for us. But
why do lenders like bad investors?
They like to loan money to people who don't need to borrow money. It's I'll give you a $5 million loan because you already have $5 million in your bank account.
Yeah, we're getting to the point where the credit unions and banks like that one-off person. They like looking at all their personal, it's like a resi loan is what I'm more than you think. And then the agency debt is can you operate this deal? Does this deal make sense?
You know why they're doing that? They're doing that because people are in trouble.
Yeah,
and they know it because they got a lot of loans out that are going into default, or they have. Yeah. They're much pickier about who they're lending to and the type of product that they're lending on because they have stuff in their portfolio that's not performing. And so they look at you like, oh, is he one of the good ones or one of the bad ones?
Yeah, and lenders are liars.
brokers don't understand. They're disconnected.
Well, even
investors are liars too.
Everybody's
the
liars.
front end. The commercial loan brokers are paid on commission, so they're just like, yeah, we'll do that, and then they take it to underwrite. It takes freaking months.
So you're talking about front of the house, back of the house. Anytime you're dealing with a salesperson, their job is to deploy capital.
Yeah.
What happens behind the curtain, they don't always know if the head wizard is going to sign off on them actually deploying that capital or not. And so their job, unless they're going to fire them, is always to go out and try to bring in loans. It's just like you're buying deals all the time and you want everybody to bring you deals, but you're not going to buy every single deal that comes to you, but you want to see all the deals because you want to buy the best ones that are brought to you. The lender is the same exact way. They want to see all of the loans, but they want to lend. They want to take the cream and they want to lend on all the best ones that are brought to them.
But they don't always know which the best ones are.
Well, it's for
They
them.
have different metrics.
Best for who?
They don't understand their own situation.
Because Trevor knows what's
Trevor
best.
should teach a class to lenders on how to underwrite their loans.
Do you know what's crazy? Craziest thing we've seen. So we're stepping into
Thing we've seen.
Not the craziest, but this is wild, I think. So 112 unit portfolio, 3 different properties. They're going into default. I come in and I'm like, I have a business plan. I want to assume the debt, catch them up on the default so the lender loses no money. And they're like, we would rather take a $4 million loss right now than have you assume it. Yeah, and get this just out of our bank.
Trevor, you just don't understand big boy math.
I probably not. That's you're right.
He doesn't understand their charter and their balance sheet and how they make their...
I don't. Yeah. I would assume I would rather not lose money than lose $4 million.
You would think.
The funny thing about me is I also don't understand big boy math.
What it is we oftentimes feel like lenders aren't very logical, but we're seeing it through a different lens. It's not logical to us, but it's logical to them on what they're trying to accomplish on their own balance sheet, what their investors are looking for, what their board wants. You know, I mean, it's...
Well, think about like that scenario. 3 properties, it's going into default. What's to keep you from going into default, right? So it's like, sure, you may look at it like these are good loans. We can catch them up. We can operate better. But their experience is completely different. Their experience is this market's effed. This property's effed.
Yeah.
It is non-performing. We want it out of here. And then if you were someone that had the 5 to 10 million liquid cash and you're coming in and saying, look, we have the cash. We just want to do the structure. Maybe they look at you differently. But if you're aggressive in your acquisitions and
they wouldn't even go through that. Like they were just like no go day one.
I had that same conversation.
There's a lot of lenders too who they don't want to tell you they're not lending because they want you to. They will never come out and say we're not lending right now.
They just cancel your loan 3 days before closing.
Their balance sheets aren't always like they have their own balance sheet just like we do, and so sometimes it's good and sometimes it's not.
And that pivots very quickly with them. Like
it can change overnight.
So how do you protect yourself in your purchase agreements and acquisitions for this type of scenario?
You run multiple loans and you just pay all the costs to do multiple appraisals and multiple...
I tell you how I do it. Every time I start talking to somebody about a deal right now, I say, we need 90 days.
Yeah.
There's a very good chance that this loan is going to take 120, maybe 150 days.
180.
Maybe 180 days. I don't know that. But by the time you get to 150, they're like, was another 30 days.
You want to sell and we want to buy, but getting the money might take a while.
Well,
so do you sign a purchase agreement at 90 and then
with extensions
I
baked
shoot
in.
for an extension baked into 120 every time.
Every time.
And the expectation of 150 right now.
And are you pre-negotiating that with like extra earnest money or how?
So we're doing a deal right now and they're like, hey, the lender doesn't want to lend because your P&Ls are messed up, so it's really hard to find a lender. But we'll give you $100,000 of hard EM right now. Just give us the extension, and then we're like, we're going to buy the deal. We don't know exactly how many days it will take, but it will close, and you'll get your money, you'll get your price, you'll get your terms. And then, like, if you're a seller selling that an $8 million asset, what's another 30 to 60 days?
Especially when there's not buyers lined up around the block.
Yeah, but where the problem becomes is with the brokers, because to them, 30 to 60 days is a lifetime.
They want to get paid.
Some brokers are very good about that.
The ones who are doing deals consistent, it's like whatever.
Because they have money in the bank.
But the dude who hasn't done a deal in the last 2 years and is like, I'm working at the golf course as a caddy now type of thing. It's like,
what are your techniques for getting the broker on board for these extensions? And the other question, extension, that is the end of the calendar year.
It's being very clear. So on the front end, the upside to the broker when you're working with somebody who's closed 5 deals
they're
this year,
going to get paid,
is that you've closed 5 deals this year. and it's like we have 3 more under contract. We've got 6 more in the pipeline. We want yours to be one of them. Every time we go under contract, we close the deal. We have not like dropped a deal. I don't think we've even really. If we go under contract on a deal, like we've bought the deal every time. Yeah. And so when brokers see that, and then you're 90 days in, 120 days in, and then you have to call the broker, and the broker's disappointed that it's another 30-day extension. Sometimes, if it's a broker that was ready to get paid, which everybody is, and I'm, obviously you want your money now instead of later, that's better. But when you just have the conversation of, hey, we're going to close this. We're giving you an additional $50,000, $100,000 of earnest money. You have to wait 30 days, or you can drop it. We can take you to court for our $200K of earnest money for non-performance on something that's not our fault. And, even obviously contractually, but there's a case there. Mm-hmm. And worst case is we just don't get the money back, but then we hold you up for 6 more months. So you're not selling it for 6 months. You're still
keeping your finance contingency in place. So
it depends on the deal.
It depends on the deal, but then also it's like, okay, you either close in 30 days or you market it, maybe go under contract in 30 days.
And nobody else is going to buy it any quicker.
And then close in 90 or 120 after that.
I will say, as a broker, one of the first rules I was taught is that time is never a good thing. You want to get a deal, like the faster the borrower is spending money on appraisal, on due diligence, on all these things, you move that along, and it is a broker's job to design that timeline and then push everything through to try to hit those benchmarks, right? It's never a good thing for a deal to drag and drag and drag and drag, and you want to get paid, and you don't want to just keep working on the same deal all year long. You want to do other deals, and it takes time.
Yeah, so we want to close it faster too, because it gets us to the next stage in our company, and we can go do the next one.
So it's okay if you're working with a buyer who will close the deal.
Yeah, it's irrelevant.
But if they've been working with people that are killing deals after they worked on it for 4 or 5 months, you're going to get some brain damage from that and go, I don't want to work with that buyer anymore.
I mean, that's where hard-earnest money comes in.
Yeah. And as a broker then, and you're working with a buyer you've never worked with before, what kind of actions do you want to see from them? What kind of timelines do you like? What makes you feel good that they are moving down this timeline? And what are the red flags?
Yeah, a lot of it has to do with how quick do they hop on due diligence? How quick are they bringing in a real team? Are they spending money? Are they working with a lender? Do they have they made their deposits for third-party reports and all that? For me, it's always about like, when do we get to the inspection? When do we get to earnest money? When do we get to, lifting DD? When do we get to making a deposit on our loan? All those steps along the way. And once the money starts being spent and you got the wheels turning, you can tell when a deal is sort of sitting stagnant and you're not moving through those things quick enough. You might have a buyer that's not all that motivated. And the other thing is, too, one of the reasons why you don't want a ton of time is people get divorced, people die. Like, my average deal that I closed, I think in my first 5 years, I went back and looked at it, and the average was about 100 days it would take me from start to finish to get a deal done. So I just knew going in that that's what I could expect. Once we hit COVID, those deals took 6 months plus because they wanted to underwrite them 5 times before we got them to the finish line. It was crazy.
Yeah, on one deal we're doing right now, they're like, well, we're supposed to close it, and they're like, well, we're getting pretty close to October, and you're not going to have your tax returns till October 15th, so we're going to wait for that. Let's wait for that, and then we can't hit your close date, so we're going to drop this after we're 2 months in with them.
Yeah, that's what I'm concerned right now, just because of that, which is, okay, now tax returns are coming in, business are done, personal isn't done, but how does that affect our ability now to actually close?
On a real lender, it doesn't. On someone who's hesitant about lending and checking their balance sheet every day, then that gives them the opportunity to drop it.
Okay, so then to put that in context, so your community bank, which you're getting a good rate at, they may really be hesitant.
Those are the ones,
Fannie Mae or Freddie Mac, they don't care.
You're good to go.
Okay.
Yeah.
But Fannie is just brain damage.
Yeah, I started 6 months anyways. Just 6 months, 6 months out of the gate. You already know it's going to be 6 months. 180 days.
I started trying to pre-flight these lenders and line them up for the future deals we didn't have under contract and start to get pre-approved because they took so long to get term sheets back, like months. And they were like, oh, we don't do that, but we'll get you this quickly. I'm like, you guys are all liars. You have not gotten us. We had one lender every week.
We're ready to give you a term sheet, but we were wondering what the payment on Gabe's GTR was.
Dude, it
Gabe
took
owns-
us.
nice car.
Gabe owns $200 million of real estate, and you want to know what the payment on his GTR is?
Hey, dude, it's like almost a percentage of a percentage point.
What in the heck are we talking about, boys and girls?
Dude, it was crazy because they
That's
were like, we'll get you
crazy.
an LOI by 3 days out. And then it's a month and a half later. We're like, can we get the LOI? And that's just
So what are you doing with your sellers in those scenarios where you're not getting the LOI?
Communicating.
Okay.
telling them.
Communicating. It's like, hey, we've talked to 40 banks. We had 10 that said they'd do it. We have 5 that we really think will do it. We have 3 that are ready to give us LOIs, but none of them have given us LOIs.
Yeah, and then are you, and you're timelining this, you're obviously going down the lending side while you're going down the due diligence side. When do you want to have your LOI in regard to releasing your physical due diligences?
Oh, I mean, we want to get our LOI. So we're trying to get our LOI within the first week now. So we're starting that process because that's our slow point. So we're really pressing the lending on the front end. So now we have like an acquisition process where everyone has their thing and the due dates and whatnot. Mm-hmm. But we're pushing that immediately because that is our biggest holdup right now. Like not our DD, not anything
It's
else.
a blessing in disguise because when it's hard to borrow money, it's hard to buy real estate,
Yeah.
which means like
Nobody's
we've talked
buying.
about, there's buyers out there that would like to transact, but they might go like, I'm going to wait until, because some of them will just go back to their normal lender and
Who
say,
won't
hey, what do
mind
you do?
it.
And they're just like, hey, we're not really lending right now.
They're not willing to call 40 banks.
Right.
And then a lot of those banks too, like you can do the loan, but it's like, okay, we want to do this at 6 or 6.5, and all the banks are like, yeah, we'll do it, but it's 7.5, 8. And then it's like, okay, the deal still works at 7, 7.5, so we'll use that lender, but we really want to go find, that 6, 6.5 rate, lower prepay, the terms that we think we can get.
And all your deals right now, are they pretty heavy value add and they're getting more stress from the lenders, or?
No, it depends on the market too, right? So like each lender has a different thing of like, I don't like that deal type, or I don't like that market type, or I don't like the timeline. So each lender, like just the deal itself will exclude it. And then some will be like, oh, that's great. You guys have a big SREO and you're experienced. And other lenders are like, we hate that. We want
Why
you
you
to be
have
buying your
so
first
much
deal.
real estate? Why you have so much?
What are you,
They wish we had Bitcoin.
Yeah.
and what are you accomplishing to your due diligence? Like how intimate do you want to know your asset while you're going down the buy route?
It varies a lot.
It depends on the deal, but it's more of like, so what we do as a process is we take Mark. So I do the first walk and we'll do like a high level walk and then see what we need for the actual inspection. And then Mark goes and does it and brings whatever he needs. He gets it a little more in depth, and then he scheduled third party if any of that's needed. So
And
Mark
then-
dictates all that.
Yeah, and then like a week after we close, me and Gabe drive by it just to see what we bought.
Nice.
That's not true.
But
I go walk it early too.
I'm getting Mark in
Usually
there
Gabe
as
does.
soon as possible because like I can know, but not to the level of like we take Mark and his team through and they're like, oh, there was a water leak within the last 10 years on this spot. I'm like, really? I don't see anything.
You know how a lot of people talk about analysis paralysis and like you spend too much time in the spreadsheet and you start to not like the deal because you get like, oh, let's be a little more conservative here or there. The same thing can happen with due diligence. It's one of the reasons why I try not to get too wrapped up. Like I'll have contractors walk it. We just walked some properties yesterday and we had our contractor walk and he's like, oh my gosh, this is messed up. That's messed up. And it's just like,
Yeah.
it's not stuff that's going to make us not buy the deal, but it just kind of like puts a dark cloud over it.
Yeah.
So you don't want to just close your eyes and not pay attention
And
to
that's
what's going
like
on.
the
but
filter of your performa with repairs and maintenance and
Yeah, it's just
You're gonna
numbers.
have some
It is
buckets
what it
for
is.
Yeah.
Yeah.
But you still want to know that like I'm not going to run out of capital. I need to have this amount of reserves.
Yeah, it's a range. So like I'm going in there, I'm like, okay, I plan for these numbers. Are we within this range? What are the risk factors of what could push us out of this? Because I know I have this spread. And like on that deal we walked yesterday, like I budgeted in $230,000 of miscellaneous repairs. That I was like, I just think these are going to come up. And then he walks through, and the inspector dude, or Mark's guy, he's like, oh, these are all messed up. And then it comes out though, like Mark's like, oh yeah, this is better though than what I planned for on the front end.
Yeah.
When you're walking, especially in multifamily, if you haven't done this very much, like you're going to walk in and it's like, oh wow, there's a hoarder, and wow, this one stinks so bad I almost don't even want to walk in there.
Yeah.
And this one has cockroaches, and this one has this, and this one. It's like, you know what? You're going to find that everywhere. But I mean, it's sort of depressing. It's like it's not that the building or the business plan doesn't work. It's just like you have to go see how everybody's living, and the type of product that we buy, people mostly don't live like we do. Like
Right.
they don't keep their house clean, or they don't, it's just there's a different lifestyle.
Yeah.
The first project I ever walked with Trevor was chipper as could be once we were done. And I was walking out there and I was like, that place is gross.
I just bought
I don't know
the
if I
project
want
I
that.
bought was all getting condemned. The one me and Gabe bought beforehand, so it was a big step
This
up.
was a great deal. Yeah. And I was like, that's yucky.
So, like,
those people are not living well.
What I'm doing on the front end a lot of time is I'm assuming like general turnover of what we might have of like, okay, like 5% of the units will have general turnover during that year. And that's a range of light to medium, light to heavy turns that we count for. So like maybe 2 light turns, 1 heavy. And then I'll take another 5% and assume that whole 5% is heavy turns too, just on the front end. So it's like, okay, we accounted for this. If we can be better than that, great. This is typically what we see, especially when you're the first acquisition of that property, that you're going to have tenants who just don't like you from moving in. They don't want change, so they're leaving.
Yeah, a lot of people will just leave because there's a new owner, new sheriff in town. Yeah.
And is that then you're expecting a 10% turnover then for the year? And you're just
Kind of,
Depends on the project.
It depends on the project. So like on that project we just walked, I was assuming 5% turnover of heavy turns. So 10% turnover every single year, yes.
Yeah, okay.
Which
That's pretty low. I mean, 10% is pretty low.
I was going to say,
turnover?
I would kind of expect more.
So, yeah, I would say.
why it's okay is the turn level. I'm assuming all of them on heavy there, and then usually we're able to be like, oh, okay, there is slightly higher, but it's 6 light turns and it's below our 3 heavy turn budget.
Yeah, I would say normally you're looking at 20 to 40% turn per year, depending on the project that you're in.
Okay.
What are you running for the cost for heavy turns versus light?
It depends on the size, but a heavy turn will be 18 to 25 grand.
And that's based on what square footage?
So like a $18,000 turn is going to be like a 600 square foot unit, and then 25 grand is like an 800, 900,000 square foot unit.
$30 a foot.
Yeah.
And again, that depends on like the level of turn, because we might go in and only have to do floors on a 600 square foot unit. You know, that might be like 3-4 grand plus cabinets, another 5, and then you're at 9 on this thing, paint for 2 or whatever it may be. So like 11 on a heavier turn, and then you're like, oh, I budgeted for 18, so we can actually do 5 heavy turns.
It's pretty cheap when you think about commercial and you're spending, 100 to 150 a foot in TIs and stuff like that. I mean, what are we spending? $20-$30 a foot on turn?
20 to 40.
Yeah, and then the other equation is, are you factoring in, okay, we're going to raise all of this in reserves and have reserves for all this, or are we going to raise reserves for 60% of it and then
cash flow
the other 40%?
So that's what we're modeling of, like, and then keeping your reserve. So I'm modeling out how we draw down that reserve and where it's rebuilt.
Yeah.
So then I make sure, because I try to target about 3% of property value in reserves, and that gives you about 6 to 9 months of payment, depending on your
3% of property value in reserves. What if you know you're going to be doing some large capital?
Yeah, then it will be more, right? Then it will be a separate budget for that plus your reserve. So we'll do our construction budget.
So you want 3% of property value in reserves, and then you want your bucketed big ticket items. You might
go, and then once you have that, you can decide like, hey, this property has been running really good for 6 months. We don't have capex coming up because we've just done all this, so we can actually sit on 2.5 or 1.5 or whatever it may be on that project. But like on the front end, I just like looking like 3%.
You've made the mistake of not being as liquid.
Yeah. I mean, we just did super heavy turn, obviously, in Astoria, and we did a bunch of the big ticket stuff. And so at refi, it's like you're not super concerned about if somebody moves out. It's like a really, really light turn that you're going to have to do for the most part, right? And they're smaller units, and so whether or not we'll sit at 3% on that, like, no, the valuation's super high, and those units are small. The rent is high for each.
Yeah, and the 3% is an arbitrary number I came up with from just like looking at our portfolio and how I've operated stuff in the past. And I was like, if I had 3%, it would have been completely fine in all of these situations. So let me just make a rule of thumb.
Yeah, that's the beauty.
As the portfolio has grown, how much better are your numbers getting? Now that you have so much more trailing, I mean, you couldn't just go off industry standard before. You had to we had to get in and get kicked in the teeth.
I think I was conservative, but I've gotten even more conservative on the numbers on the different places I'm running it. So like I'll underwrite it to a 10% management fee, even though I know we're going to be at 4%. Because I want to see what the next person is going to operate it at too. And then I'll have all these other factors baked in. Plus, the best part has been having Mark. So my construction budgets are actually dialed with concrete a plan of what we're going to do, rather than me being like, I think we're going to do this. I don't know when over the next 5 years, so that really sucks if we got to do all this year one, which kept happening.
So that brings in another question: is the management fees. Like in Portland, we see a lot of these really terrible contracts where the rate's really low, like 3.5%, but they've got
service charges and all that.
On-site labor, they've got administration fee, they have a tech fee, they have a maintenance labor rate of like $120 an hour. And so when I was talking to our Fannie lender on this project, they're like, well, your pro forma needs to make sense because our strategy is to lower the management fee significantly, and then do a slight rent bump. And he's like, well, the appraiser has to confirm that's going to
market rate.
That's what we run into is we'll have appraisers and lenders that will not accept some of our line items for our expense because they'll say you might be able to run it that, but the next person won't be able to.
They have standards.
I mean, I have properties that are like vintage 70s product that'll run in the 20-25% expense range. Well, nobody can do that. Like everybody runs 35-40, and so you have to find a middle ground there. And we've even had it where they're like, well, we want to see your management agreement or whatever, but it's like having to go to a board and say like we've got to get an exception because we don't ever underwrite to less than 7 or 8% or whatever.
And you're making a bet too. Like, I mean, that's what investing is, right? You're risking money and making a bet on a guess of what will happen. So like what I'm trying to do is crank all these levers. So I might think market rate today is $13.50 and I might run it at modeling it like no rent increases for the next 2 years and then like a 4% for the last 3. So I'm trying to be conservative on where I think rents will go because if we can hit that number, I truly believe rents will be much better, then we're good. But the problem we run into is if you do that on every single one, you'll kill the deal. Right. Or you'll make it less attractive to investors. So now we try to show like our full thought process of like, no, rather we used to just give everyone this is the most conservative, and then we'd be like, yeah, we'll get like a 20% return, and then we get 200. And then you have all the people who are like, what the hell? Like, I would have done that. Yeah. It's like, but here's the range of where we think it will be at. And here's the factors that determine that. So if rates are at 5%, we can refi here. If it's, a 5.5 cap versus 6.5 cap, if our vacancy's here, if our market rent is this, these are all the factors that affect it. And here's the spread and here's why. And then just communicating
what you're talking about is stress testing the deal, which is the same thing the lender's doing. Back to our last conversation, but they're stress testing it on different metrics.
Yeah, but it's like the feature untold is a feature unsold. So we weren't telling investors that on the front end, so they were getting scared about the deal. But we're like, no, we've thought about those things, and this is where we know we can, like, obviously not 100%, but we're very confident we can hit this.
Yeah,
that you're really
that's
happy
the fine
with.
line of how much of a story you're telling and your upside, and like because you're setting expectations.
Correct.
Well, that's what we've talked about this before, but that was like the hardest thing when we all started working together and underwriting together, because you've got this huge sheet that has all these variables, and then you're looking at a deal and it's like, this deal's not good, but it should be good. And Gabe would look at a deal and not do any of the underwriting and be like, that's a good deal. I know that's a good deal. And so then we'd have to look at it and try to figure out like, okay, Trevor was really conservative here. I'm more liberal there, but I'm more conservative here. And Mark's more conservative here. And so then you end up giving out underwriting and you're all looking at it together, and everybody has the one thing where they're like, no way it hits that. And then they're conservative. And so once it all gets compiled, the deal's at like half of what it could actually perform at.
Because you're taking everyone's worst.
Because you're taking everybody's worst.
Yeah.
Not like kind of trying to meet in the middle. And so then when you do the stress test of like, what's the potential upside? Where it's like, okay, what if Trevor's right on his liberal number and I'm right on my liberal number? Like I'm usually, depending on the market, like I'm hitting rents, Trevor's higher on expenses, I'm lower on expenses. Like we're all meeting in the middle somewhere, and then you look at it and it's like, dadgum, this is a great deal. We should do 10 of these.
And then it's looking at the deal of what is the business model and what are you targeting. So one may be like a cash on cash return or like a sale, like AAR, IRR, but then you might look at a deal. So I was looking at this 112 unit, and I was like, I don't like this from a 5-year, like you put money in and sell perspective. It doesn't really make sense to me in like terms of investor returns. But where it makes a lot of sense is there's a really heavy uplift on the front end. You can pull all that capital back out and then have less risk because you have less capital in and hold it longer. And it's like, oh, the deal makes sense with that debt structure, but not this one.
I remember Mike when he first spoke at SRE, like one of the very first meetups, and he picked up my postcard and he goes, This vacancy survey is bullshit. I can understand why you were coming from that angle, because it was like, oh, SMI runs at 3% vacancy. Well, right at that moment when we picked up the phone, we had 3%, or we looked at the reports, we had 3% vacancy.
And they look at when it's lowest and decide to send it out.
If you look at that, each property individually over the course of the year, your economic vacancy is far more than 3% because you had turns throughout the year. So your actual vacancy that day, the day we hit the phones, might have been 3%, but over the course of that year, you had an economic vacancy maybe of 10%. Yeah. So when you underwrite that deal, do you underwrite to 3? Do you underwrite to 10? You have to figure out where in there you're actually going to run, because the numbers, even though the market runs at this low vacancy number, none of your properties are going to hit that number, to your point.
And that's kind of what I like about some of these bigger T12s and performers that the bigger property management companies put together, because they put gross potential rent as if it's fully leased up at market, and then they do a lease loss to market, so they're discounting all the below market leases. Then they're taking an economic loss and an actual vacancy loss. And to me, as an operator of a small unit portfolio, it's, if you're 3% or 15%, you have 15 to 17 days to turn a unit. And even if you don't have to do any repairs, you have to time the turnover of that unit to get it done in that amount of time. And you have no control a lot of the times over when units turn over. And so actually operating at a 5% vacancy is really difficult to do.
It's hard.
Yeah.
And that's where operations is key, of where we have Mark, okay, how do we get these turns done in not a month, but 5 days? And then how do we get it advertised early, so right when you're finishing, you're moving them in?
Yeah, one thing they talked about at the multifamily summit I went to was contract only, labor only contracts with their contractors. And you guys have Mark, so it's different. But what was interesting is they're essentially warehousing all their materials, all their supplies, and they're only contracting out labor. And so that they're essentially working with that GC who doesn't want to have a marketing arm, doesn't want to take a few weeks off in between projects, and they're just keeping them busy with below market rates on the labor. And then they do bulk savings on the purchasing side, which is like, we've got a warehouse account with Home Depot where you get the pro discount that all the GCs get, but we have a warehouse line. We get significant savings even on top of that. And so if you have infrastructure for savings and materials and then liquidity, that can really, now you become an operator that can perform at a whole different level.
Yeah. The interesting thing too is when you look at something that swings and we were talking about this the other day with expense ratios on operations, when you're looking at something that swings your net income at the end of the year, or even your gross income at the end of the year by 2% or 3%, it's like, that doesn't feel like that much really. But then when you're saying, okay, what is my cash flow after all expenses and after debt payments, a 3% swing on NOI is like a 10% swing on your cash flow. Yeah. Right. And so the actual value of the property, if you can swing one of those numbers by 3%, is massive, but it doesn't feel like that much when you're in the weeds, right? When you're looking at the spreadsheet on it.
Yeah.
And so the vacancy piece is huge from the sense that okay, you have fixed costs on vacancy, but if every time you turn a unit and you have 10 out of 100 units turn in a year, you have an extra month of vacancy, you're swinging your income by 2 or 3%, which swings your cash flow by 10%.
Well, and then from a refi perspective, it's huge. So even on we went and walked their Astoria property, their new construction thing yesterday, and they have an office space they're going to rent for $600. And it's that's $144,000 in value at a refi from this one little office space.
Yeah. At a 6 cap.
Or a 5, I can't remember. Mark probably should run it at a 3 cap.
So one thing I really like on multifamily or income properties is just expense ratios. I think that's just the cleanest way to quickly look at something. I want something with a high expense ratio, and I want to know what are the things that I can change to lower that expense ratio. So kind of what are your experiences on operating properties? So for example, our acquisitions a 58% expense ratio. I felt like I could get that down well under 50, but we're at 50.
It depends. So the biggest thing that will swing your expense ratio is your rents, where you're at. So the lower the rent you have, the higher the expense ratio. Right. So when I'm underwriting these deals, I'm actually assuming we're running at higher expenses than what the previous owner is.
Yeah.
Because they're not taking care of the property the way we would, but we're also going to push the rents higher.
Yeah.
So, and they're doing a lot of things like self-managing, so they don't have a fee in there. They're like, no one has landscaping in there, or dryscaping, or anything like that. Or like their maintenance and repairs. A lot of the properties we buy, they're living off the cash flow, so they're not reinvesting those. So like my expenses are actually higher. We're gaining efficiencies on certain things that we're doing, but overall it's higher a lot of the time.
And when you're analyzing T12s, say you've got a T12 with a lot of CapEx in it and a lot of heavy repairs in it, are you stripping that out?
Sometimes. So it depends. And a lot of time too, these owners will think they're doing tax plays. So they're like charging these weird fees that are like building rent and contractor rent to my own contracting company. But I'm like, you're taking it as income in this company over here versus long-term cap gains. Like, I don't know why you're doing this.
But isn't
I
it
don't
better
care.
for you as a buyer because it's bringing in more expense?
Well,
that you're going to strip out?
Potentially. So now you're negotiating that in, but realistically, like the broker's like, yeah, you're not going to have these expenses, so we're basing our pricing on.
Now you got to convince the lender.
And now you got to go take those.
Yeah.
That's where it becomes a problem of like, hey, lender, these are, and they're like, but on their tax return it says this. I'm like, yes, I know. They're just doing some weird thing that they shouldn't be doing. We're going to run it here.
Are your lenders requiring to see their Schedule Cs?
No, not typically.
Sometimes, yeah.
Not really.
I would never buy a deal off somebody's tax returns.
So what are you showing the lender for the income of the property? Are you showing
it's usually a P&L. They want the last 2 to 3 years, depending on. Then they look at it and they're like, if there's really large CapEx, they ask for longer P&Ls.
And then do you manipulate those P&Ls to take big CapEx out? So
we have to justify it. So we have to bring documentation or like explanations for those things. So we're giving them
a real P&L, and then you're saying these items.
Yeah. So you'll give, here's their P&L that they gave us. Here's where we think it's at. This is removed. And they ask you specifically if they're a good lender, like, what is the CapEx? Let's remove that right now before I take it to committee.
Gotcha.
Or have an explanation for why these are, because those are below the line. It's not NOI, but it's dollars. We need to know where they went and why.
This is a good.
Actually, I take it back. Maybe I would buy a deal off somebody's taxes. Because then you can buy it cheaper.
That's what I'm thinking. Like,
but no, Lynn. I mean, you can't
sell it on their
It's
taxes,
just not accurate. It's not accurate. If you look at it, it's just like, oh, this property's not worth anything. I've had underwriters look at my properties and they're they call me up and they go, well, this one loses money. How come you own this property? I'm like, did you see how much cash flow it gave me last year? Like, I don't understand. Like, the cash went in my bank account. How did it lose me money?
It's crazy that they don't understand
depreciation. They don't understand CapEx. They don't understand any of it.
And then what's
some of the underwriters?
Yeah.
What's your guys' strategy with bonus depreciation as far as
we don't
you don't take it at all?
Do not need it. Yeah.
And you're not raising capital.
Our strength is having plenty of depreciation to offset, I would say.
For you guys,
we're swimming in depreciation.
We're good at that.
Yeah.
part.
So also,
we've got one thing dialed.
Yeah, because for investors, depending on the investor type, like they also don't need that much depreciation because they might, if they're not a real estate professional, it's like, let's cover it up at a property level. But like, if we're putting 25% down on an asset that's going to cash flow $200,000, we probably still have $100,000 left over of depreciation just from straight line.
Yeah, and that's where kind of the position I'm in is where a lot of my partners, their spouse is a real estate professional.
Yes, they want maximize.
They
want
Mm-hmm. And then like now looking at I'd rather kind of sell it in 3 years. Like it actually looks like you get better ARR or annual average return if you just sell it in 3 years. But now if you've bonus depreciated, now you got to recapture it, forces an exchange. I have talked to other people who are like, well, as long as you don't sell, but in the first 5 to 7 years, most of that bonus depreciation is in the 5 to 7 year buckets, and so your recapture isn't as bad if you're selling after year 7 with the bonus depreciation.
Well, and then that's where you have to decide if you want 1031 it or not.
And that's the problem with the syndication is now you have a lot of different partners. And so how does that work? Can partners choose to not 1031 and some partners choose to 1031?
No, you could drop and swap.
If you're like in a JV, we're buying a deal where they're doing a drop and swap because they're all in one LLC, but some of them are doing equity contribution, some of them are doing 1031, and then some are just cashing out. So they're doing a drop and swap before so they can go different ways.
And are they doing all that title work at the sale? Like,
we would have to.
They're doing it like 3 days before closing.
Which you're not really supposed to do, but people do it.
No, it's you can, and I think they are okay in their case because it's based on intent and what you're doing, and they've owned the property for 10 to 15 years, and they are doing a 1031.
Well,
So
there's also-
their specific situation, I believe, qualifies, but it's way cleaner and no questions asked if you do it a year or two in advance.
Yeah, correct. And that's the guidance from the IRS. The 1031 person I use, they're like 90% of people do the drop and swap deed work right before closing, a day or two before closing. But there's also a second paper trail, which is your tax return and how are you reporting those taxes.
Yes.
So it is possible that you can report a tax return in April that says you did do a drop and swap, but you didn't actually do the deed work. You do the deed work later, and now so you've got some intent proven.
And then with the depreciation thing, so like we have partners who are, they have their spouses as real estate holders and they're professionals and whatnot. And they're like, the talk with them is like, hey, we don't need depreciation really right now because we have all these our other portfolio plenty of depreciation. Let's create an LLC and then we can pivot, allocate that however we want. So maybe we take more cash flow or more ownership and you take more of the depreciation and everyone gets a win.
Yeah,
and you
that's how
can
I
do
did
that
it first.
Unless you're on a tick, you can do that. If you're within just an LLC, JV, you're good to distribute that however.
So everybody always talks about not wanting to pay taxes, and it seems like there's a couple ways around that. One is you use debt, so you just borrow against the asset, so debt's not taxable, or you do a 1031. But if you're swimming in depreciation like we do, I love the idea that every once in a while you go, that's one we're going to sell, and we don't. If we wanted to 1031, we could, or we could just take the money and we don't really have to pay a lot in taxes because we have so much depreciation.
Yeah, we're going to do that pretty soon here.
It's the beauty of having a condo development company lose a bunch of money.
So,
The beauty of
So my
losing
entire
money.
portfolio right now.
Are you okay, Mike? Are you gonna tell us a story right now?
Yes, I am okay. Just to get that.
Okay.
Yeah.
All right. You guys want to wrap it up?
Yeah,
yeah, I
that's
didn't
good.
get to talk about what I wanted to talk about.
We'll do it
can
next
do that
week.
We'll do another
Great
episode.
Informational episode.
Great news.
Well, this was a great first episode for the four of us in the SMI studio. It's a lot of fun. We have air conditioning in here. It's nice and comfortable. We love it. This is great.
It's much better.
All right, Deal Junkies, we love you guys. Thanks so much for listening. We're growing. Please share us, and we will see you next time.